All right, so uh, we're diving into something today that, may not sound like the most exciting thing in the world. Conflicts of interest, especially in finance.
Yeah.
But stick with us, okay? Because this is about way more than just, some boring rules or whatever. We're talking about trust,
Mm-hmm. Yeah.
especially when it comes to your money. I mean, think about it. What if the person who is, you know, giving you financial advice or managing your investments,
Yeah.
what if they were like secretly pushing something that benefited them more than you?
That's really it. That's the core of the issue.
Yeah.
When we talk about conflicts of interest, we're really talking about your financial well-being, your
Oh,
future. You need to know, really, you need to be confident that the people who are handling your money are genuinely looking out for you, not
right.
just trying to line their own pockets.
Okay, so we've got a big stack of your research
Yes.
all about this topic,
Yeah.
and what we really want to do today is kind of give our listeners a cheat sheet
Okay.
for navigating these situations.
I like it.
You know, we're going to go through some like real world examples
Absolutely.
and really just give you the tools to spot these conflicts of interest
Yeah.
and like understand, what's the big deal? Why does this even matter?
Okay, well, to start us off,
Okay.
I think it's helpful to just have a clear definition. What are we even talking about when we say conflict of interest, particularly in finance?
Right.
So in the financial world, a conflict of interest happens when someone who's involved in a financial decision,
Mm-hmm.
they have some kind of personal stake in it
Okay.
that could maybe cloud their judgment or affect their loyalty.
Oh, so it's like, they're getting something out of it
Yeah, exactly.
besides just, doing their job.
Exactly. And in the financial services industry, the stakes are so high, right?
Right.
We're talking about people's livelihoods, their
Hmm.
savings, their futures. So conflicts of interest become especially critical.
Right, because this could be like whether you've been investing for years
Yeah,
or you're, just starting out saving for retirement.
absolutely.
Like these conflicts can actually impact you
Mm-hmm.
directly.
They can.
So let's jump into it.
Okay.
Let's jump into a scenario.
Right.
Okay. So imagine you're sitting down with your financial advisor,
Mm-hmm.
and they're super excited about this particular mutual fund.
Okay.
Right? This seems great.
Yeah, sounds good.
They're telling you all about it.
Right.
But then you discover
Uh-oh.
that your advisor actually gets a commission every time they steer a client towards that fund.
There it is.
So the question is, are you really getting the best advice for you?
Mm.
Or are you getting the advice that puts the most money in your advisor's pocket?
Right. Are they working for you?
Yep.
Or are they working for themselves?
So that's a little concerning. What can someone do to protect themselves from
Yeah, good question.
these hidden incentives?
Well, I think the most important thing is full disclosure. Like your advisor has to tell you about any compensation they're receiving for recommending specific products,
Mm-hmm.
right? That's the law. But, you can even go a step further, right?
Wow.
Instead of working with an advisor who gets commissions, you could look for an advisor who operates on a fee-based model.
Okay, so what does that mean? Fee-based.
So, in a fee-based model, the advisor charges you a flat fee or a percentage of the assets that they manage for you,
Okay.
right? So their incentives are aligned with yours.
Mm-hmm.
The better your investments do, the more they earn.
Okay, so it's kind of like the difference between like paying a doctor for their time and expertise
Okay.
versus the doctor like getting a bonus from a drug company
Oh,
for prescribing you a particular medicine.
I see what you're saying.
Right. You'd want to know that.
You would. You absolutely would.
Yeah.
So with a fee-based advisor, they're not incentivized to push you towards any particular product.
Mm,
They're just focused on helping your investments grow.
got it.
But even with a fee-based advisor, it's never a bad idea to get a second opinion,
Mm-hmm.
right? Just like you might with a medical diagnosis.
Right.
It's your money.
Yeah,
You want to make sure that the advice you're getting truly aligns with your goals,
absolutely.
not just, with your advisor's bottom line.
Okay, that makes sense. Let's move on to a different scenario.
Yeah.
One that maybe hits a little closer to home for some people.
Okay.
Imagine this. You need a loan, right?
Okay.
And you've got a good friend
Uh-huh.
who happens to be a banker,
Mm-hmm.
and they say, hey, I can help you out with that.
Okay. Sounds good.
Seems like a lucky break.
Yeah, I mean, who wouldn't want to get a loan from their friend? But but
Yeah.
here's the thing. That is a classic conflict of interest.
Oh, really?
Oh, yeah, absolutely.
How so?
Well, because your friend, the banker, Their job is to make lending decisions based on, objective criteria,
Right.
based on the bank's policies, not on their personal relationships.
So are you saying that it's like it's not fair?
Well, it definitely creates an unfair advantage.
Okay.
Right. And it's not just about favoritism.
Oh, yeah.
There's a risk there that your friend might give you a loan
Mm.
that you might not actually qualify for,
Oh,
if you weren't friends.
okay.
And that could actually end up hurting the bank.
Oh, how so?
Well, if they're giving out loans to people who can't really repay them,
Yeah.
that's bad for the bank's financial health.
Okay.
And ultimately that affects all of the bank's customers.
So how can banks like prevent that from happening?
That's a good question.
Like how can they make sure that their lending practices are fair?
Well, I think strong policies are key.
Okay.
Right? Banks can either prohibit employees from lending to people they know personally,
Okay.
or they could require like an independent review
Mm.
of any loans like that,
Oh.
just to make sure everything's fair and it follows the rules.
Okay.
Transparency is also really important,
Right.
you know.
Like being upfront about it.
Yeah, employees need to disclose any personal relationships that might influence their judgment.
Got it.
And really to remove any doubt,
Yeah.
they should probably just recuse themselves entirely from any involvement in loans
Right.
where there's even a hint of a conflict.
Okay, so just step away completely.
Yeah, better safe than sorry.
All right, that makes sense. So this seems like it's really important when, we're talking about people's money and finances
Absolutely.
to have this level of scrutiny.
Mm-hmm.
Um, okay, let's talk about brokers.
All right.
So here's another scenario for you. Imagine a broker
Okay.
who is managing investments for their clients,
Yeah.
but at the same time,
Uh-huh.
they're also trading
Okay.
for their firm's own account.
Hmm.
So they're kind of wearing two hats there.
Yeah, that's a tricky one.
Right. Is that even allowed?
Well, it definitely raises a red flag
Okay.
because it creates an opportunity for something called front running.
Oh, okay, I've heard that term.
Yeah.
What is front running?
So front running is an illegal practice
Okay.
where the broker uses their knowledge of their clients' orders
Mm-hmm.
to make trades for their own benefit
Well,
before they execute their clients' orders.
so they're like taking advantage.
Yeah, essentially they're using their clients' information
Wow.
to make a profit for themselves.
That's pretty bad.
It is. It's a clear breach of trust,
Yeah.
and it really undermines the integrity of the market.
Okay, so how do we prevent that?
Well, to try to prevent front-running financial institutions, put in place something called Chinese walls.
Okay, I've heard that term before. I
Yeah.
don't really know what it means.
Yeah, it's kind of it's a strange term.
Yeah.
But basically think of it as information barriers that are designed to prevent the misuse of confidential client data.
So it's like a real wall.
Yeah, it's a metaphor.
But instead of like bricks and mortar,
Mm-hmm.
it's made up of like rules and regulations.
Exactly, you got
Yeah.
it. So it involves having separate teams, separate systems,
Okay.
and strict rules about what information can be shared between different departments.
Got it. So it's trying to keep those two things completely separate.
Yeah, you want to maintain a clear separation
Okay.
between different functions within the firm,
Right.
especially when you're dealing with sensitive client information.
Okay, so it's all about minimizing the temptation,
Yeah,
right?
I mean, that's really what it comes down to.
To like blur the lines
Mm-hmm.
between your own personal gain and what's in the best interest of your client.
It's about structuring the system so that doing the right thing is the easiest thing to do.
Okay, makes sense. Now let's just quickly touch on a few more scenarios, just to kind of cover all our bases.
Good idea.
We've got financial planners who are incentivized to push products that, get them a high commission,
Mm-hmm.
even if those products aren't really the best fit for the client's needs.
Right. That's a big one.
We've got analysts who might be biased by, their firm's investment banking deals.
Yeah, that can definitely happen.
Wealth managers recommending stocks that they happen to own personally.
Uh-huh. Another tricky situation.
And fund managers who might be influenced by something called soft dollar benefits.
Yeah, soft dollars, that's a That's a whole other...
That sounds kind of nice.
Right.
What are soft dollars?
Well, it's kind of a euphemism,
Okay.
but basically it refers to perks that brokerage firms offer to fund managers,
Okay.
like free research, other services,
Okay.
in exchange for the fund manager doing business with that brokerage firm.
Oh.
So it sounds harmless on the surface, but the problem is these benefits could subtly influence the fund manager's decisions.
Oh.
Right. And potentially that could be at the expense of the fund's investors.
So if, like, your fund manager is getting wined and dined by a brokerage firm,
Yeah.
how can you be sure that their advice is really in your best interest?
That's the million-dollar question.
Right.
It's really hard to know.
That seems like a problem.
And that's why independent oversight is so important.
Okay.
Right. And transparency. Investors need to know that the decisions are being made solely based on their best interests.
Right.
Not as a way to, repay favors or maintain relationships. That could be harmful.
Okay, so we've covered a lot of different scenarios.
We have.
Right. And it seems like the thing that connects all of them is that there's this imbalance of power and information.
You're absolutely right. When one party has more information or more influence than the other, it creates these opportunities for exploitation.
Right.
And that's why it's so important for you, for the listener, to be aware of this, right? To be aware of these potential conflicts,
right,
and to be ready to ask the right questions.
Don't be afraid to kind of like push back a little.
Exactly.
Right.
Don't just take everything at face value.
Okay.
You have a right to know what's going on with your money.
Okay, so it's about empowering yourself.
Absolutely, to make informed decisions.
To demand transparency from the people who are handling your money.
Yeah, you've worked hard for that money.
Right.
You deserve to know.
I think this has been a really eye-opening start to our deep dive.
I agree.
But there's more to cover.
Oh, absolutely. We're just getting started.
So stay tuned for part 2, where we're going to keep uncovering these complexities of financial conflicts of interest.
It's going to be good. Welcome back to our deep dive into the often murky waters of financial conflicts of interest.
Yeah, before we started this whole thing,
I
was kind of thinking mostly about those big scandals.
Right.
Like those CEOs who get caught insider trading, or those stories about like banks manipulating markets.
Yeah, the big headlines to make a profit.
Right. Those definitely grab our attention.
Yeah.
But, conflicts of interest, they can be much more subtle.
Oh, yeah.
And often they happen on a much smaller scale.
Okay.
Affecting everyday decisions.
So not just the big Wall Street stuff.
Right, exactly.
Okay.
And that's why I think this deep dive is so important for our listeners, because it's about, helping them to understand these less obvious situations, and to navigate their own financial lives with more awareness.
Yeah, it's like giving them a magnifying glass.
Exactly.
So they can see those hidden things. I like that. A magnifying glass for your finances.
All right, so I want to go back to those scenarios we were talking about earlier.
Okay.
Kind of those rapid fire examples.
Sure.
One of them was financial planners, right?
No.
Who might be incentivized to push products that earn them a high commission.
Right.
Even if those products aren't really the best fit.
Yeah, it's all about the incentives.
For their clients.
Right. And sometimes those incentives can be misaligned.
Okay, so what do you mean?
Well, think about it this way. Let's say you go to a car mechanic.
Okay.
And they tell you that you need a whole new engine.
Uh-oh.
When maybe all you really need is an oil change.
Oh, okay, so they're upselling you.
Right. Are they really being honest?
Yeah.
Or are they just trying to,
make more money.
Maximize their profits?
Right.
And it's the same thing in the financial planning world, Sometimes you might have a financial planner who's recommending a product that's going to earn them a big commission, even if there's a simpler, less expensive option.
So how do you know? How do you know if they're being honest?
Well, that's a great question. And one way to mitigate that risk is to seek out what are called fee-only financial planners.
Okay, so what does that mean?
So fee-only planners, They charge for their advice and their expertise directly, rather than earning commissions on the products they sell.
So they're not getting like a kickback
Exactly.
from selling you a certain thing.
Right. They're not incentivized to push you towards any particular product.
Right.
Their success is tied to your success.
Got it.
If your investments do well, they do well.
Okay, so their interests are really aligned with yours.
Exactly, and that's what you want to look for.
Okay, that makes a lot more sense.
Yeah.
Okay, let's move on to analysts.
Analysts, yeah.
So these are the people who, research companies.
Mm-hmm.
And they put out those ratings, right? Like buy, sell, hold.
Right. Buy, sell, hold. Those ratings can have a big impact on stock prices.
Okay, so their job is to be like objective.
Mm-hmm.
Right.
In theory, yes.
But what happens when
But here's the thing.
the firm they work for has other interests?
Yes, that's where things can get tricky.
Right.
Because you're introducing a potential conflict.
Okay, give me an example.
Sure. So let's say you have an analyst who works for an investment bank.
Okay.
And that investment bank is trying to get a big deal with a particular company.
Right.
Right? They're trying to underwrite a stock offering or maybe advise on a merger. Now, there's going to be a lot of pressure on that analyst to issue a positive research report.
Even if it's not, like, totally true.
Even if it might not be completely warranted. Right, because if the analyst issues a negative report, it could jeopardize that big deal.
Okay, so they're kind of stuck between a rock and a hard place.
Exactly. They're trying to do their job.
Yeah.
But they're also trying to help their employer.
And those two things are like pulling in opposite directions.
Exactly.
So what can be done about that?
Well, a lot of firms, they try to prevent this kind of conflict by establishing what are called firewalls.
Okay, so you mentioned Chinese walls earlier.
Right. Chinese walls, firewalls, they're very similar.
And I was imagining like a literal wall.
Right.
But it's not really like that, is it?
No, it's not a physical wall. It's more of a figurative wall made up of policies and procedures, regulations that are designed to prevent the flow of sensitive information.
Oh, okay. So between departments.
Exactly. So you want to keep the research department separate from the investment banking department.
So that they're not, like, influencing each other.
Exactly. You don't want the investment bankers pressuring the analysts to issue favorable reports.
Okay, so it's all about protecting the independence of the research.
Exactly. You want the analysts to be able to do their jobs without feeling undue pressure or influence from other parts of the firm.
Makes sense.
Yeah.
Okay, one more scenario I want to touch on is wealth managers recommending stocks that they personally own.
Yes, that's another classic conflict. Because how do you know if they're recommending that stock because it's truly a good investment or because they just want to pump up the value
of their own holdings,
of their own portfolio?
Right. It's kind of like...
It's like a chef recommending their own restaurant.
Yeah.
You know, you'd want to know.
Right. Is it really the best?
Is it really the best restaurant in town?
Or are they just trying to get more customers?
Exactly.
Okay.
So transparency is really key here.
Right.
Wealth managers,
Yeah.
they have to disclose any personal investments that could potentially influence their recommendations.
Got it.
And ideally, they should recuse themselves entirely from advising clients on specific investments where they have a personal stake.
So just take it off the table completely.
Yeah. If there's even a hint of a conflict, it's best to just step away.
Okay, so we've gone over a lot of these scenarios.
We have. We've covered a lot of ground.
Yeah. If there's one thing that our listeners can take away, like to protect themselves, what would it be?
I think it really comes down to awareness.
Okay.
Asking the right questions and maintaining a healthy level of skepticism.
Okay, so don't just like automatically trust.
Exactly. Don't just take everything at face value.
Right. To do your research.
Do your homework. Ask questions.
Ask questions.
Demand transparency. You know, don't be afraid to challenge your advisor, your banker, your broker.
So it's about being like an active participant.
Exactly.
In your finance.
You're not just a passive bystander.
Right.
You're in charge of your financial future.
That makes a lot of sense.
And by being informed and engaged, you're not only protecting yourself, you're also contributing to a fairer and more transparent financial system.
So it benefits everyone.
Ultimately, it benefits everyone.
All right, this has been, I think, really eye-opening.
Yeah, me too.
But I feel like there's still, like, more to talk about.
Oh, absolutely.
Right.
We've only scratched the surface.
So stay tuned for part 3,
right,
where we're going to explore some solutions.
Yes, let's talk solution.
Right, to these conflicts of interest.
That's what we need. We need solutions.
You know, as we're wrapping up this deep dive into these financial conflicts of interest, it's really made me realize that it's not, just about finding the bad guys, right? Or exposing scandals.
Right.
It seems like there's something
It's more systemic?
more fundamental
Yeah.
about the way that the whole system is set up.
Absolutely.
That kind of creates these conflicts.
The incentives are often misaligned.
Right. It's like the way it's structured almost encourages these behaviors.
Think about how many financial advisors are compensated, right? Their earnings are tied to the products they sell,
Right.
not necessarily to the long-term well-being of their clients.
So it's almost like even if they start out with good intentions, they get pushed.
The system pushes them
towards sales.
Towards prioritizing sales over advice.
Over actually giving good advice.
And that's a problem.
So how do we even
Yeah, it's a big problem.
How do we begin to address that?
Well, I think it requires us to think about solutions that go beyond just individual accountability.
Okay.
Right? We need to look at the structure of the system itself and think about how we can realign those incentives.
So it's almost like changing the rules of the game.
Exactly.
Right.
So that everyone's playing on a level playing field.
But how do you do that?
Well, I think it requires a multi-pronged approach, right?
Okay.
We need stronger regulations that close loopholes and hold institutions accountable.
Okay.
We need greater transparency
Right.
so that consumers can actually make informed decisions.
Right. So they can see what's going on.
Exactly.
Yeah.
And we need a shift in the culture of the industry itself.
Okay. So that seems like a really big one.
It is.
Right? Like changing
It's a huge challenge.
The whole culture.
Because right now it feels like conflicts of interest are often just seen as the way things are done.
Yeah, it's just
part of the business.
Business as usual.
And that's a dangerous mindset.
So how do we change that?
Well, I think we need to start by normalizing these conversations.
Okay.
Right? We need to be willing to talk about these issues openly.
Yeah.
Raise concerns when we see them.
Right.
And hold people accountable for ethical lapses.
So it's about creating a culture where doing the right thing isn't just
encouraged.
It's expected.
Yeah, it's the norm.
It's the baseline.
Okay.
And that's going to take a collective effort, right?
Yeah, it can't just be like one person.
It can't just be individuals
trying to fight the system.
It requires a shift in mindset across the industry.
Okay, so for our listeners who are, listening to this and they're like, okay, I want to do something.
Right.
What can they do?
Well, I think there are a few things.
Okay.
First and foremost, educate yourself.
Right. Stay informed about these issues.
How? How do they do that?
Read articles, listen to podcasts like this one, engage in discussions about financial ethics. The more you know, the better equipped you are to protect your own interests.
So you can spot those red flags.
Exactly.
Okay.
Second, don't be afraid to ask questions.
Yeah.
Right? Challenge your advisor, your banker, your broker. Demand transparency about how they're compensated.
Right.
About potential conflicts of interest.
Yeah.
About their decision-making process.
So it's okay to push back a little bit.
It's more than okay, it's essential.
Okay.
It's your money. You have a right to know.
Right. It's about being an active participant in your own financial well-being.
You're not just handing over your money and hoping for the best. You're engaged. You're informed.
Got it.
And third, consider supporting organizations and initiatives that are working to reform the system, right? That are promoting ethical practices.
Right.
There's power in collective action, right? By joining forces with others who share your concerns, you can amplify your impact.
So it's about using your voice.
Yes.
Right. And your choices.
Absolutely.
To push for change.
And finally, lead by example.
Oh, okay.
Right.
So it's not just what other people are doing.
Right. It starts with you.
Okay.
Be honest and transparent in your own financial dealings. Demand integrity from the people you do business with.
Okay.
Your actions can inspire others to do the same.
It's about, like, raising the bar.
It's about raising the bar for everyone.
Okay, so imagine
a world where financial services are truly client-centric, right? Where transparency is the norm and conflicts of interest are minimized.
So trust isn't...
Trust isn't a luxury. It's a fundamental expectation.
Right, that's the world I want to live in.
Me too.
We've
covered a lot.
Covered a lot of ground here.
A lot of ground.
In this deep dive.
You're in murky water.
Hopefully our listeners are feeling a little more empowered. Informed. About all of this.
And ready to take action.
Right, to ask those tough questions.
Absolutely.
So thank you for joining us.
It's been a pleasure.
On this deep dive.
Always a pleasure to be here.
Stay tuned for more.
Yeah, we'll have more deep dives coming soon.
Deep dives into fascinating topics.
We'll see you next time.